right, good afternoon, good morning, depending on where you're coming to us from today. Another great educational webinar that we have here at Advanta IRA. Really excited with the guest speaker and the guest presenter that we have today. It's been a while since he's been on, but he's brought a really great information. We're going to talk today really about getting started as an LP investor. There's a lot of different investments that we hold here at Advanta IRA that clients make where your IRA is acting as a limited partner. We're going to define some of those terms as we go through the presentation if you're new to this aspect, but our guest presenter today is really going to talk about what you need to know if you're looking to become an LP investor and what is involved in that process. My name's Scott Maurer. I'm the Vice President of Sales here at Advanta IRA. I'll be your host for the webinar today and cover a couple quick things about IRAs in general before we jump into what our guest presenter has to share with you. If you have any questions in regards to IRAs, solo 401ks, self-direction in general, you can contact me. My number is here as well as my email and our website, which is another great place for information. Now, as we go through the webinar today, if you are listening to us live and you have any questions, please just type your question into the question box on the GoToWebinar control panel. I'll make sure we get those questions asked of either myself or our guest presenter today as we go through it as well. So get those questions typed there. If you're listening to the recorded version, again, here is my contact information. I know that Gino is going to share his information as well, that you can reach out with any questions that you have if you are listening to the recorded version. Just a quick note about Advanta IRA. If you are new to our company, we have been around for almost 20 years now. And the only thing we do is handle the administration of self-directed IRA accounts, people using retirement accounts to invest in a multitude of different IRA alternative investments, a lot of them geared in the real estate realm. And that's why we're talking today about being an LP investor in a lot of those types of real estate deals. We currently have over $3 billion in assets under management or under administration. We have over 13,000 active clients working with people throughout the United States. We have no geographic restriction with where we work with individuals like yourselves that are listening. And as far as what a self-directed IRA is, very quick, it's an account that gives you as the account owner, or maybe your investors if you're working with, you're looking to raise capital, gives that IRA owner the ability to have complete control over what they are investing in and choose the type of asset and the actual asset class that they wish to invest in. They're not being pigeonholed into selecting among a bunch of mutual funds, publicly traded stocks. You're usually typically with a self-directed IRA investing outside of the stock market, getting that money off of Wall Street and onto Main Street and investing in things that you understand that you can control. The IRS will certainly allow you to make these types of investments as long as you have a custodian who is willing to hold those assets. And that's exactly what we do here at Advanta IRA. Now, as we're talking today again about LPs, LP interest and what that means, just a quick note, a little bit about private partnerships or LLCs. Now, in general, a lot of people listening to the call probably have heard about an LLC, certainly heard about partnerships in the past, and they can be formed for a variety of reasons. Now, in our realm and what we do with self-directed IRAs, typically it's someone has formed an LLC or partnership for a multifamily real estate syndication, or they're doing a hedge fund, or they're doing some private equity. But within these entities, typically the partnership interests are divided into two classes. There are the GPs, or the general partners, and typically the general partner is an individual or an entity that is managing, controlling the day-to-day operations, and they're often compensated for their actual work done for the partnership, and that's usually laid out within the partnership and LLC formation documents and the private placement memorandums, exactly how those individuals are compensated. So those are people maybe you think of are going to be more actively involved in the day-to-day operations of this entity. And then you have your limited partners, your people who are providing the capital, they're putting in the cash. The LPs are then compensated based on their investment and the production and the profits that are realized by that partnership in the LLC. They're not getting compensated for their work because they are really truly passive investors. They are not having any say-so in the day-to-day operations of that particular LLCs. Now, when we talk about IRAs and 401ks and why Gino's on to talk about this today is with retirement funds, IRAs and 401ks are always going to be an LP investor or limited partner. In general, if your IRA or 401k is investing as an LP, you probably should not be involved personally in that deal as a GP where you're personally being compensated. There are some rules that the IRS has in regards to that structure. So again, IRAs are always going to be an LP, and that's why again we had have our guest speaker coming on today to talk about that. Now, why do people use IRAs for LP investments? For a couple different reasons. One, talked about moving from Wall Street to Main Street. People are tired of the stock market. Now, right now, as we record this live, the stock market's been hitting highs, but we all know at some point that's going to end. And the market's going to go back down, or it's going to get more turbulent and rocky. And individuals would like to have a more consistent rate of return or invest in something that they understand much better. So they use their IRA to get some of their money really out of that maybe a rockier stock market and into something that they can really truly diversify. For some people, there's some tax benefits. The investments are the income that you're receiving back to the IRA are tax deferred or tax free, depending on the account. But for many people, it's simply a new source of capital. They're presented with an investment opportunity, again, that they don't want to miss out on, and their IRA or 401k is the entity that has the cash for that particular investment. And most people don't know that this is possible because most IRAs, most 401ks are with banks and brokerage houses that are really offering you only those products that they will hold. Again, the mutual funds, the stocks, and anything that's publicly traded. They are not going to advertise your ability to take your money out of the accounts with them and go put it into a multifamily syndication or private equity fund. That just doesn't make business sense, right? If you're looking to eat lunch somewhere, the place you're thinking about going to eat lunch isn't going to tell you that there's a place down the road that does something completely different if you're interested in that. So that's why you're not going to hear about it. Every custodian could hold these investments, but the brokerage firms typically will not hold private partnerships on their platform. It doesn't fit really within their business model. I mean, the reason why a lot of people look to look for IRAs as LPs, if you are raising capital, going back to your existing database and showing people another way they could invest with you. Maybe they've used their savings account, or maybe they took out, they have a home equity line that they like to use for investing, and rather than use that cash, they can use their IRA to make the next investment for you. But I think really the biggest one, a couple on this slide. Again, there's trillions of dollars in retirement accounts. The latest estimate was $37.5 trillion in IRAs and 401ks that are out there that are looking for or need investment homes, needs a place to have that money put. But it's also that a lot of people, when they're looking to invest as an LP, and I'm sure Gino's going to talk about some of this, when you invest as an LP, a lot of times you're locking your money in for 3-5 years, maybe even longer, depending on the investment, and you don't expect to touch your IRA for the next 10 or 15 years anyway. That's why the IRA can be a great place to then invest. Otherwise, you're looking at your personal savings account that you may need for a medical emergency, some other life emergency that comes up. So using your IRA as an LP investor where your money is going to be tied up for 3 to 5 years can make a lot more sense. Very quickly, the types of funds that can be used, any type of IRA, any type of former 401k, former 403b for school teachers and public school employees, former thrift savings plan, the members of our military that you have, basically that's your 401k as a member of the military, or also postal workers. Any types of these accounts can be self-directed. So again, if you have an IRA, you can use that money to invest as an LP. If you have an old 401k, an old employer-sponsored plan, you can use that money as well. The only restriction is going to be on your current employer plans. If you have a 401k or a plan through your current employer, they may restrict your ability to move that money over. When you do have one of those accounts and you'd like to get this money in place for an LP investment, it's either doing a transfer or a direct rollover. Both are tax-free movement of money from your current account over into the self-directed account to make that LP investment, and we walk you through that process on as well. So did have a question just pop in that while we're on the topic, someone, can you use an educational IRA, also called a Coverdell education account? Yes, you can also use Coverdell education accounts and self-directing them into an LP investment, or really anything that is self-directed. So yeah, great question that came in there on the question box. Keep those coming as well. So one slide I'll finish on before we bring on our guest speaker. It's really, I think, when you're talking about investing, whether you're investing personally or using an IRA account, it's really, I think, a lot of times a good exercise to figure out what kind of investor that you are. Are you someone who wants to be more active, where you are managing rentals or rehabs, or you're wholesaling, where you're in complete control, hands-on, but you're eating up a lot of your time and energy and expense, and you're responsible for the details, right? So that's some people, that's their mindset. They want to be more active and want to be more involved. Or are you someone who tends to be drawn to investments that are more passive in nature, the private placements where you are acting and you're becoming your IRA, or you personally as a limited partner or an LP, where you don't have as much time commitment. You're not bothered by that minutia, but at the same time, you're giving up a little bit of the control over the investments, and you're trusting the people that you're investing with. And that's something I know that Gino is going to talk about today, talking about evaluating and knowing who you're working with as an LP. So that's my little spiel on the self-directed component. I did want to make sure we have the bulk of the time saved here for Gino to talk and cover what he's going to talk about today. So our guest presenter today is Gino Barbaro, co-founder of Jake and Gino. It's a multifamily real estate education company. They have plenty of assets under management. He's also a best-selling author, investor, business owner, entrepreneur. I've known Gino for a couple years now. Like I said, we've had him on before. Excellent speaker on the topic, does a lot of talking, and so we're really happy to bring Gino back. So this time I'm going to invite Gino in and obviously let him share his screen and share his slides as we go through. Gino, how are you doing today?
Scott, I'm doing good. I need to add in a little bit of color to the presentation. Sure. First thing is, I've known Scott for more than a couple of years. He's actually one of our first vendors with self-directed IRAs. I know Scott's a recovering attorney. I don't think he mentioned that in the beginning.
Sometimes I skip over that, right?
Yeah, but I can't skip over it because I have to mention that you are the smarter person on this webinar right now. So I have to put that out there as well. Listen, you did we've done 3 syndications, and every one of our syndications was done through Scott. An amazing job. I mean, I love the way they set up their whole platform. Now, I want to really structure this for limited partners, but if you are somebody on here who's raising capital, look at it from that perspective. How can you serve that limited partner? And Scott's company, their team, has a great platform for you to be able to raise capital and give that white glove service, because that's what you ultimately want when you're using an IRA company. You want a dedicated advisor like Scott's team gives you. They give you a beautiful landing page. They give you all of this education and answer all the questions. So just, a plug I'd like to say that Scott didn't expect me to say, but I truly believe that, and that's in my heart of hearts. Dozens of our students have used Scott's company as well. So, just want to give you a big shout out there, Scott.
Yeah, thanks, Gino. I appreciate it. Yeah, definitely unsolicited, but much appreciated. And yeah, looking forward to the presentation. And again, anyone who's listening live, we already had that one question come in on the educational IRA. Keep them coming as we go through. Again, whether it's for myself or Gino, put them in the question box. We'll make sure we get to them. And Gino, I will turn it over to you.
Thank you, Scott. And we've got those numbers a little skewed. We have over $350 million in assets under management, and we have over 2,200 units that we've closed since we started. Jake and I started back in 2011, and it seems like a lot of units, and it actually is, but 1 or 2 deals a year, sprinkling a couple of syndications, and you look back a decade later, we currently own 1,700 units. But as I was telling Scott, we've got 3 deals under contract in the next 90 days, which is going to be a little bit over $30 million worth of deals. So for us, we're active investors, but we've also created this platform called the Jake and Gino community that we started back in 2016 when we wrote the book, Wheelbarrow Profits. And for me, it was love at first sight. I just really love the education. I love to coach. I became a life coach, and coaching, getting on calls with Scott, getting on webinars, getting on podcasts. For me, it's like I'm giving back, but I'm also receiving so much benefit. So that's one of the main reasons why we started the education after thinking about it for a couple of years. But this is what our students have done. They've closed over 81,000 units. They've done over $5 billion in deal volume. And look at that number. They've raised over $450 million. And I would venture to say at least 25% of that is probably through self-directed IRAs. And, side note, when we've done our 3 syndications, we've exited out of our 3 syndications. So all the deals that we own are just my partner, Jake, myself, and another business partner, Mike. And we have our employees investing with us as well. But Out of our 3 syndications, the very last one, over half of our money raised came from self-directed IRAs. That's why it's such an amazing tool. And I remember the very first time I heard about self-directed IRAs, it was around 2010. Scott, I thought it was too good to be true. I thought somebody was lying to me. I'm like, I've got all this money in a 401k in my IRA. I can't touch it, but now you're telling me I can invest in real estate? It was like the best thing since sliced bread for me. I was so excited. So if you're out there and you're a skeptic and you're saying this is too good to be true, it's one of those times that it's not too good to be true. It is true.
Yeah,
Okay.
That's definitely something we've heard over the years as well. Yeah, it's too good to be true, or I wish I'd found out about this a lot sooner, because it's, again, not something they're going to tell you about. And a lot of people aren't going to tell you about this type of investing that you do as well. So.
No, they're not. And the reason why I'm passionate about, this topic, this LP topic, is because back in 2005, my very first passive investment, I was a restaurant owner. So Jake and myself, we met at the restaurant in 2009. We're affectionately known as, I was the pizza guy and he was the drug rep. And we met in 2009. But before I met Jake, my very first passive investment, I was sitting in the parking lot in my restaurant, and a gentleman drives in. He's got a nice gold Maserati. I'll never forget this. He comes in, and he was referred by a friend, and he said, "Hey, Gino, do you want to invest with me?" I said, "Sure. I've got $172,000 in my bank. I'll invest with you." "What are we investing in, by the way?" He said, "Well, we're going to be investing in a mobile home park." I said, "Here, take my money." Little did I know it was a passive investment. Little did I know he was creating a syndication. I had no idea how to invest. I had no idea about due diligence, about underwriting. I just had money. He had a deal, and I invested with him. And everything went along really good for about 6 months. And after 6 months, the check stopped. And then after 9 months, no more communication. And I was furious. And after 18 months, the deal went up in smoke. And after all these years, and I'm really thankful, believe it or not, that it happened, because it really precipitated and it really prompted me to take responsibility. Because in this part of the market cycle, what we're seeing right now is we're seeing limited partners being very angry at general partners, and general partners not being able to provide the returns. And it happens, and it happened to me. And I was really angry at Maserati Mike for what he did to me. But when I really look back at it and I've reflected on it, it wasn't all Maserati Mike's fault. It was partially my fault, because I didn't know the vehicle I was investing in. And we're going to go through this 3-step framework, because the first part about it really is the sponsor, is the Maserati Mikes of the world. Did I vet the Maserati Mike of the world? No. I was only concerned with, I've got money, Mike's got a deal. The person with money gives the person who's got the experience the money. That person with the experience keeps the money, and the person with the money gets the experience. It happened to me, and it's happened to countless other investors. That's why over the last 18 months, I've been seeing the problems and how the market's been shifting. And we're going to be talking about where the market's right now and how it's shifted. But that was the real reason why I just had it in my mind that I want to create a product to help passive investors to be able to invest in real estate. Look at it from basically investing as an active investor, but do it passively. And there's certain things that you need to learn. And there's certain, like Scott had gone over, certain benefits to investing passively. Listen, you're a doctor, you're a lawyer, you're a surgeon, you're out there, you're really busy. Do you have time to deal with tenants, toilets, and trash? You probably don't, but you've got money and you heard that real estate is an amazing vehicle. Well, let's dive into why passive investing and how to become a great passive investor. Now, the first thing is the 3-step framework. I want you to picture a sponsor. Right now, I've got a jockey there. So the jockey is the first part of this 3-step framework. The saddle is the second part, which we'll get to, and the horse is the third part. Now, the sponsor is the most important part when you're investing passively. Most investors, like I said, look at the deal. They've got money. They've got to find a deal. Let's worry about the deal last. You as a passive investor really has to focus on the sponsor. There's a lot of questions you need to ask the sponsor. How long, and I've got them here, how long has this sponsor been investing in real estate? What is his or her track record? Now, this third one, I want you all to write this down because this is important. As you're looking at opportunities, whether you're buying, into a crypto fund, or whether you're investing in a single-family home portfolio, or whether you're looking at a multifamily, you want to know who their assembled team is. And this is not only the team of the general partners, because there may be more than 2 or 3 people on this team. You want to get to know every single one of them. And you also want to know their vendors, like if they are using a self-directed IRA, if they are using a property management company, if they have a securities attorney, which I'm sure they do, all of these different intricacies, who is financing the deal for them? You need to understand their team and how long they've been doing business. It's really, really important. The business plan. You need to understand what these investors, what these general partners are doing with their business plan. And I think the communication style is so important. You want to be able to, we have a question to the general partner, you pick up the phone or you text them or you email them and say, hey, I've got a question. And they should be very responsive to you. Remember, they are stewards of your capital. Their job is to really take care of the capital, preserve it, and try to grow it and give it back to you. And by them having a track record, the experience, having an assembled team, having a business plan, and be able to communicate that is crucial. Now, when I look back at Maserati Mike, believe it or not, he had a track record. He had done a few deals. He had some experience, but he had no team members. His business plan was terrible, and he communicated whenever he wanted to. And I'll throw this out to you all listening to this. If you're willing to commit $50,000 or $100,000 of your hard-earned money to an opportunity, I would venture to say you should be able to get onto an airplane, fly on, and look at that deal. I wish I had done that with Maserati Mike. I was living in New York. I could have flown down to Florida, looked at his mobile home parks, and said, this is not what I want to invest in. That's what I should have done, but I didn't do that. I would have saved myself a ton of money. And I'm just putting it out there for you. If you're looking to invest with a partnership group and you've never done it before, and you want to get boots on the ground, you want to take a look at the asset, you want to go into the market, you want to look around what's in the city, what's in the surrounding areas, that's a good way to do it. And you may say, oh, I don't have the time to do that. But remember, you spend so much time earning that $50,000 or that $100,000. What is half a day's time and maybe a $500 airline ticket worth it to you to be able to save all that heartache? If I had done that, I may not be with Jake right now. I wouldn't have invested with Maserati Mike. So that's really important. Now, this alignment of interest I want to jump into, but another question that you can ask a sponsor is NOI growth. It's net operating income growth. Over the last few years in real estate, you could have bought a deal in 2019. You could have done nothing to the deal, and just by the market compressing, cap rates coming down, these sponsors could have sold deals and they could have made a ton of money. Ask them specifically. This is a great question, and if they don't know the answer to that, or that's a red flag for me. What was your NOI growth on your last couple of deals? And if they say it was flat or negative, I'm not saying you should or you shouldn't invest. Just be wary that they may have gotten lucky over the last couple of years. So that's something that I would really, really focus on. Now, the alignment of interests. This is the second part. This is the saddle. Now, the sponsor's sitting on that saddle, but this is all about you. As the investor, as the limited partner, we rarely think of this. You have to understand, ask yourself, why are you investing in real estate? Is it the right vehicle for you? Now, if you've got a self-directed IRA, I'm going to be completely transparent and honest with you. I think it is an amazing vehicle because you've got money earmarked for retirement. That money is not liquid. That money is sitting in that account. You probably can't take it until you're 59 and a half years old. Let's say you're 35 or 40 years old. You've got a time horizon. What a great way to put money into a vehicle like real estate. Let it sit there, let it grow, let it matriculate, extract the equity, and continue to do that. But as that passive investor, you need to ask yourself, how much capital do I want to invest in these deals? And if it's your last 10, 15, 25, 30, 40, $50,000, I would be wary because real estate is risky. And if you're banking your entire, investment on a deal and a sponsor says to you, hey, you know what, there's very little risk in this deal, you'll get all your money back, you need to push back on that sponsor, because a lot of sponsors have been saying that over the last couple of years, and limited partners have not been questioning it. So you have to understand that as well. Make sure that that works. And also, ask the sponsors, how long is my capital going to be held? The sponsor may say, hey, you're going to get it back in 18 months. Well, does that align with you? Great. Do it. If they're going to say 3 to 5 years and you're saying to yourself, I don't have 3 to 5 years, I need to get my money back, does that really align with you? So understand that those alignments have to align with you. And another big mistake that I made with Maserati Mike, Scott, was when I invested with Maserati Mike, Mike did not put any money into the deal. I was the only one who had skin in the game. Now, those alignments didn't really align. Those interests, they really didn't align, because when that deal went south, Maserati Mike had nothing to lose. He just walked away from the deal. He didn't fight for the deal. And that is such a learning lesson for me. I want my sponsors to have skin in the game. I want them to say, hey, if this deal is going down, I'm going to work really hard because I've got a lot on the line for this deal. And Maserati Mike didn't have a lot on the line. That was a huge learning lesson for me. And I guess one other thing that sponsors, a lot of them do, who are really good, if they make more money in the deal, they get compensated more. So they are incentivized to work harder and to get a bigger return for the investor. Ask them. It's called the waterfall in multifamily and in commercial real estate. It's really the return on this investment as the internal rate of return, or as the rate of return goes up. As that rate of return goes up, hey, the sponsor should get compensated more. That's great for you because he's working harder for you because he's making more money in the back end. He makes more money, you make more money. That's how you align your interests. Now, this third one.
If I can jump in with a quick question there, and I encourage people who are listening to ask one. So when you're talking about evaluating a sponsor, would you find a lot of that information then in their business plan, in their PPM documents? Kind of where would sit someone who's looking to be an LP? Where should they be looking to obviously ask the question of the sponsor, but then where do you go to verify?
Yeah, that's a great question. I mean, listen, I would start Google. Well, if you want to get into syndications and you want to start looking at sponsors, my first thing I would do is I would Google multifamily syndicators, self-storage syndicators. There are a ton out there. Start opting into their lists. So you start opting into their lists, and you'll start getting opportunities, and you'll start seeing deals come into your inbox. I would go onto websites like Go Invest Clearly. Go Invest Clearly is a great platform where they have LPs rating GPs. I think another company called Cashflow Portal, Perry Zhang has put up a company like that. He's putting up a site right now that is actually they're rating sponsors, whether they're GPs or LPs. So it's actually a whole platform for you to be able to see what people are talking about. There's companies like Bigger Pockets as well. You can go on there and search, see what people have said about other sponsorship groups. I would actually go on Google. That's the very first thing I would do, is go on Google and start looking at every single one of them, opting into all of their lists, and start doing searches. Start doing searches of history. And, just because a syndicator, they may have foreclosed on a deal 18 months ago, I don't want to just say that that's a bad sponsor, because over the last 18 months, if you're in a southeast state like Florida, and all of a sudden insurance tripled and rent stalled, does that make that person a bad sponsor? I don't really think so. I mean, if he had 20 other great deals and he had one deal go bad, you have to take it in its totality. So I think looking at that, and hey, listen, if you are somebody who's really wants to take a deep dive, you do a background check on the person. Spend a couple $100 and do a background check on somebody, because once again, you're putting your hard-earned money, and everything looks great on the internet until it doesn't. So I've had students go out and actually do background checks and see people who have had bankruptcies, lost deals, and then you have to take that once again into the totality. But make sure that if you're looking at a sponsorship group and there's 3 or 4 partners, there's Scott, there's Gino, there's Jake, that you look at every single one of them, each of them individually as well, because it's really important that you do that. Did I answer that question, Scott?
Yeah. No, yeah, excellent. Yeah, great answer. And yeah, and again, anyone listening live, get those questions answered. Let's talk about the deal.
So the deal. So this is the third part. Man, I like Maserati Mike. He's a really good sponsor. I like the fact that he's got some skin in the game. I like the fact that our interests align. I'm good with having my money 3 to 5 years there. I feel really comfortable about the whole scenario. I like the market that I'm in. I like the deal itself. I like the market. Now it's the deal. That's the third part. Now we're focusing on the deal. And in this next slide, I want to talk about understanding what's going wrong. But in the deal itself, we're going to talk about the buy right, the manage right, and the finance right. So here, this is important, this slide, because understanding what went wrong in this market cycle, over the last, 2 or 3 years, I know from multifamily has had its challenges. I mean, office space is probably the leader in pain, but I was telling Scott before we jumped on, in 2022, deal volume was down 60%. In 2023, deal volume was down 40%, an additional 40%. And if you look at it, multifamily peaked in 2022. We're down 28%. And I'm venture to say we're probably another 20% at least going down. And for me, that is amazing news if I'm a limited partner, if I'm a passive investor, because I know there's going to be opportunities. Now, the real problem that would happen in this past market cycle was just like everything else. Interest rates were low for so many years, Scott, and there was just so much money out there, private equity, and there's new groups out there raising capital. And when capital flows to a certain asset, I mean, look back in 2008, what happened to oil. All that money went to commodities, prices go up. And that's exactly what happened with multifamily in 2021 and 2022. With all that stimulus money, PPP, people needed a place to put their capital. Interest rates and the cost of capital was so cheap that people were just, what they were doing is they were literally going out there and overpaying on these assets. And even worse, what they ended up doing was they were getting short-term bridge financing, which in our industry, it's been used for a long time. It's just a problem. You have 24 months, you have floating rate debt. And in 2022, if we all remember, it doesn't seem like an eternity ago, interest rates were 3.5%. People started getting this short-term bridge financing. 24 months, after 24 months, it resets. Well, what ended up happening, when you have 11 rate hikes the quickest in history, the whole system got shocked. So 2023 and 2024 rates are at 7, 8, 9%. All of a sudden, your cost of capital has tripled. Your expenses have gone up. Yes, rent has gone up, but it's just a complete shock to your deal, because all of a sudden your cost of underwriting, your cost of the deal itself has gone up threefold. And a lot of these investors, they have something called rate caps, where you can buy insurance on these deals, where if interest rates go up a certain level, they'll pay the difference. The rate cap insurance got to be so prohibitively expensive that they weren't able to do this. And now a lot of these investors right now are just in limbo, because they're waiting for rates to go down, which is not going to happen, I don't think, in the foreseeable future, because we have all this inflation worries. So they've got them there. So these banks are continuing to extend. And I mean, there's going to come a reckoning where they're going to say we can't extend anymore, and they're just going to be taking the keys back. So that's the bad news. The good news is that there's a lot of opportunity right now in the market. And I think there's a lot of deals that are going to be coming in the next 12 months. And one thing I've seen over the last 2 years, brokers were very difficult to get a hold of. They had so much deal flow, and they weren't responsive to us. Now, a lot of our students are saying, hey, guess what? Brokers are returning our calls because there's not a lot of deals. And if you're on this right now, when you get off this call, go to LoopNet, go to Crexy, go to auction.com, go to all these different websites. You're going to start seeing deals on these websites. Whereas a year ago, they wouldn't even have reached these sites, because they would have been sold. So all I'm saying to you right now is, let's learn from history. We're at a high interest rate market right now. If people are complaining about high interest rates, I get it, but the only way you're buying deals right now is based on that interest rate. You can't buy a deal saying to yourself, I know rates are going to go down. I'll wait. I'm going to buy a deal. Hopefully rates go down. I'm going to overpay. That's not happening right now. So just be aware. If, syndicators are out there saying, hey, we're buying this deal, we're paying a little too much, but we're going to refi this deal in the next 18 months. That is not buying that asset correctly. So just be aware of that. Now, our 3-step framework, I think, is really important. One day Jake is in his garage, and he's always out there with his chainsaw. He's always cutting the grass and all. And he sees this wheelbarrow. And I want you all to really use this framework, whether you're buying a single family home, whether you're buying an apartment complex, self-storage. I would even venture to say, if you're buying a business, you should be able to use this framework. And that wheelbarrow, he saw it was tilted and was on the ground. And he saw the two back legs. One of the back legs was buy right. The other back leg was finance right. Those are fixed. When you buy your deal, it's fixed. Bam, it's done. When you finance it, it's fixed. But what did I just say? A lot of these syndicators and a lot of these groups out there were getting short-term financing, so the financing wasn't fixed. And after 2 years, the debt comes due. Guess what? It doubles. The finance right falls, that leg falls, and the wheelbarrow tips over. And the manage right portion of the wheelbarrow is the wheel itself. It's in constant motion. So when we talk about buy right, it's important to think as a passive investor. You have so many opportunities and you have so many options because Jake and myself, we're active investors. We are what we call vertically integrated. So we manage our own properties. We're in the market ourselves. We're limited to within a 3-hour geographic radius of Knoxville. So we've been in Kentucky. We're looking at deals in North Carolina. We're in Knoxville, Chattanooga, Nashville. So we're really, geographically restricted. As a passive investor, you can be in California and you can invest in any market you want, which is phenomenal. You can choose the market. You can choose the sponsor. You can choose the type of asset. I would love to tell you, hey, let's do multifamily, but you may not like multifamily. You may want self-storage, or you may want to invest in an opportunity zone, or hey, I'm comfortable with single-family homes, then invest in single-family homes. So you have the opportunity to diversify as well. You can buy older buildings, newer buildings. You can buy different strategies where you buy a property that has what we call a value add component, where you're adding value to the property, or you can buy a property that's stabilized. But to become crystal clear, you need to formulate what we call the buy right framework and the buy right criteria. So as a passive investor, think about the first thing you want to invest in is the sponsor. Remember, let's pick the sponsor. But I think more importantly, I would also pick the market. Let's say you live in Dallas and I'm in Dallas. I want to stay in Dallas as a passive investor. Well, let's choose the Dallas market and then let's go choose the sponsor. And then after you've done that, let's choose the criteria that we're looking for. Now for us, as I'll go through our criteria so you can get an understanding of what it looks like as from an active investor's perspective. We like to look at properties right now from the buy right criteria that are a little bit newer. We like properties that are 1980s and newer just because of where the pricing is. That's the first component. The second component is we like to look at the certain parts of our market in Knoxville. We like to look at certain median incomes. So, properties that have median incomes of less than $50,000 in our area are a little bit more challenging when it comes to collecting rent. That's a great question to ask the sponsor. When you're looking at the deal, you're saying, Mr. and Mrs. Sponsor, what's the median income of the area? If the sponsor doesn't know, that's a telling sign that he hasn't done his due diligence on the area. Crime is another thing. Look at the crime maps. So as you're starting to fill out your criteria, what are you looking for as a passive investor? Do you want to invest in older deals, newer deals? Do you want to invest in marginal areas of the market? Do you want to invest in up-and-coming areas of the market or more stable areas of the market? You also want to look at if I get into more detail with this buy right, for us, we even get as granular as we like apartment homes. We like assets that have garages. We have like assets that have, that basic apartment home feel, 2-bedroom, 1.5 bath townhomes. That's a great type of criteria for us. We also like assets, buildings that have certain amenities because we know tenants love these amenities, washer dryer hookups. We like to put in dog parks. If it's got a clubhouse, great. Now you see, as you're formulating your buy right criteria and you're looking at that and you're getting these different opportunities as a passive investor, they'll start popping up and they'll say, well, this doesn't fit my criteria. This building's too old. I don't like this area, gone. But then when one does hit the table, you're like, oh, this is the deal that I really like. So start formulating your buy right criteria, thinking about what you want to buy. And then, as you have these opportunities, you can say to yourself, not really too sure about that. And, the only issue, I'm going to go into the 3 pillars of real estate, is your criteria does change as the market cycle changes. For us, when we first started out back in 2011 and 2012, we were buying assets that were a little bit older, only because the price of those assets was so much cheaper than the newer assets. So it's really important as you're formulating your buyer criteria to be flexible with the criteria. Trying to think if there's anything else that I really want to hit on with this buy right criteria. If you guys want to learn more about the buy right criteria, you can just email me, gino@jakeandgino.com, and I can send you out a copy of our Real Power Profits book. It'll give you it'll lay this framework out a lot more for you. Now, the manage right, this is important for passive investors because you're not going to be managing the asset. You're going to be passive, but you need to understand who is managing the asset. And I think over the last 24 months, with all the money that's flowed into this business, there's a lot of people who haven't had operational experience. So if you're looking at a deal, just make sure you understand who the property management company is. When we did our syndications, we were managing our own properties. But that doesn't mean just because we're managing our own properties, we're really great at it. I mean, there's a checklist of questions that I have that I can share with you as well on questions that you need to ask the property management company or your third-party property management that can alleviate some of it, because this is something important, I think, that most people overlook in multifamily. We are always looking at spreadsheets. We're always looking at numbers, but the property management is the first line of defense. When you go into an office and you go to rent a unit, the first thing that you see that leasing agent sitting in that chair and they're greeting you. How is that? I would personally, if it was me and I'm looking to invest in a deal with John, the sponsor, I would personally secret shop his deal. I would secret shop his property management company. If they have any other assets, I would get on the phone and I would try to rent an apartment from John and see what his process looks like. And if you're in the market, I would even get in the car and I would check out their processes and see how that is. And I've done that down here. When I moved to Florida, I was looking at buying some assets down here. And it's really revealing and shocking to see some of these property management companies. And if you don't like their systems and their processes and how they're managing units and how they're renting them out, the numbers can look great, but I'm telling you, they're going to have problems with operations long term. So please do yourself a favor, learn about the property management company. And if they are using third-party property management, don't be afraid to give them a call and to interview them. And don't be afraid to ask the sponsor, what other assets does this property management company manage? Go look at the other assets and look at it from a totality perspective, because with property management, it can be challenging. I mean, it's not always a property management company's fault if an asset is not running properly. Sometimes owners can't, invest in their assets. So they just let them go and the property management can't spend any more money. But if a property management company is managing, let's say, 3 assets for this owner and all 3 of them don't look good, that's a telltale sign. Just be aware of that. And I think that the third one I didn't mention, I skipped over the finance right. But the finance right is so important because what you've seen, like I mentioned, over the last couple of years is that people have been getting really risky debt. Just ask the sponsor, what type of debt are you getting? Is it non-recourse or is it recourse? Usually in syndications, it's typically non-recourse, which means they are not they're not personally guaranteeing these loans. They're non-recourse, so that's an important component. If the deal goes bad, they basically lose the deal. As a limited partner, you are not personally liable for anything other than your investment. So that's the great thing about being a limited partner. The sponsors, they lose the deal. It's maybe challenging going forward and getting another deal in multifamily, but they're not personally liable for the loss other than the debt that they're signed on. And it can be challenging, but making sure that they have the right financing in place is important. Find out who the mortgage broker is. Find out the term that they're getting. Find out the interest rates that they're getting. All the different minutia in it. Is the loan assumable? How many years of interest only on this loan? And if they're not willing to share that information, That's another telltale sign with the sponsor. You want the sponsors to be transparent. If you're asking the sponsor, can I see your underwriting? And the sponsor says, oh, we don't give that out. I would personally not invest in that opportunity. I want to see what they're seeing and what they're forecasting. If they're not willing to give you a trailing 12 months and a rent roll, I'm sorry. I'm personally not comfortable in investing in an opportunity when I don't have all the information. So just be aware that those are something that I would really, really stress. Scott, do you have any questions? I know I've been talking.
I was actually just about to ask you all that. And this is kind of right what you're just talking about is, as an LP, what rights do you have to that information? Is it you typically outline that the GP can share the information or that they have to? Because I think that's a very important thing as an LP to understand that, like you said, you can ask to see their underwriting. You can ask to see a copy of the loan documents and what their terms are. But what rights do you have as an LP typically? I mean, I know things might vary. But what do you typically to that? You say, hey, if you're not going to share it with me, you're required to, or hey, they're going to say, hey, I'm not required to, and you can take my deal or not. So
that's a great question. I would say I would ask an attorney, but I'm saying just from my perspective, when I had those syndications, I've got my underwriting. I'm going to share it with you, Scott. If you're investing with me, I have nothing to hide. I'm going to share with you my T12. I'm going to share with you my rent roll. And it's just really trust. And how are you supposed to make a decision if I'm not willing to share with you my information? I'm sorry. That's just something that whether they're legally liable or not, I'm just saying if a sponsor says, no, I'm not really comfortable sharing it, my question is, why aren't you comfortable sharing it? If everything's great and it's on the up and up, I mean, why wouldn't you want to share some information like that? That's why on the front end, you're vetting these sponsors out. That's why it's a great question to ask and get to know before you make a commitment, before you actually wire the money. You want to be able to go through an underwriting, and that's why I created the Passive Investor Pro. I've got coaches that when you join, you get online with our coaches, they'll look at the underwriting with you. That's part of the deal. You want to look at the sponsor's underwriting and make sure that, hey, is rent growth 15%? Or are you projecting, 3%? Why are you projecting these numbers? Why are you, in effect, let's say, for instance, why are you raising more capital than you have to and then giving it back to us as part of cash flow? Why is that going on, for instance? You really want to have the whole entire total picture of this opportunity before you commit your money. And I don't think any sponsor who's asked that, if they're withholding that information, Scott, I wouldn't feel comfortable investing with them. That's just my personal opinion.
Good, yeah, and I think that's a great illustration. Again, yeah, you probably, as you go through a lot of those documents, you're going to find, the PPMs, whatever, that you are not required to share, open up the books necessarily. But like I said, Jade, I think it's great to ask, and the people that will, like you said, are not going to have anything to hide. It's the ones who don't want to share any information with you. Just sit back and I'll send you your payments. That's where you're going to definitely want to ask more questions, or have an attorney or have a financial advisor look over some of those documents, or use like you said, you have in your system there to vet. If you get the information, this is how you vet it. You may not know the numbers you're looking at and what they mean, but you can certainly find people who will and who can help you out.
Scott, I hate to spend people's money, and you just mentioned something to me, but if I had gone to a syndication attorney or securities attorney back when I met Maserati Mike, that attorney, and listen, I know attorneys are deal killers, I get it, and that's their job, but that attorney would have killed that deal in 3 seconds. They would have told me, absolutely not, I am not allowing you to do this deal with this guy, because number one, he's violating securities law. Number two, his underwriting is a joke. He doesn't have any underwriting. Number three, where's the rent roll? Where's a T12? Like, this guy has no information for you. You're investing on a shoestring. So that if at the time I would have, let's say, paid $300 for an hour consultation, that would have saved me a ton of money. So if you have a financial advisor and you want them to read the PPM, is great. But the PPM, sometimes they're just marketing documents. You want to get to the nitty gritty. You want to be able to see and be able to forecast what that sponsor is forecasting. And like I said, when we did ours, it was open. You want to see our underwriting? This is what our underwriting is. This is what the rent roll is today. I'm not going to give you any shiny, rosy predictions. This is what rent we're actually collecting today, and this is what we're projecting down the road. And if, like I said, once again, they say no, if Maserati Mike, if I didn't even ask him that question and he said no to me, that would have been a red flag to me. And once again, maybe it's not a deal killer. Maybe you still like the sponsor. Maybe you still love the deal. Maybe you still love everything about it. Take it in all of its totality. Did you like the way the sponsor is running his other deals? Does this align with your interests? And is the deal itself, you think, a deal killer?
Yep, great. Yeah, great. Like I said, great information. Like I said, just people ask questions as an LP. It's your, like I said, it's it's your money. You've worked hard for it. Like I said, take a flight somewhere. Do a little bit of digging. Hire someone to look at the paperwork and evaluate it for you if you have to, and spend it. So you spend a little bit so you don't lose a lot.
And Scott, the reason why I'm mentioning all this stuff is for an LP, I want you to really build a foundation. This may seem like a lot of work, but once it's done and you have the foundation and you know how to vet the sponsor and you have a buy right criteria and you've learned how to underwrite a deal and you know what you need to look like for, what you need to be looking for in a property management company, and you know the type of financing that deals get, all of a sudden it becomes so much easier. And you're really, you're never going to eliminate risk, but you're really limiting a lot of the downside risk that you have if you just go in there and focus on the deal itself. That's, like I said, once again, is where the whole entire mistake has been over the last 3 or 4 years. And the reason why I also want to create a really empowered army of limited partners. And it's sort of selfish for myself, is these last couple of years, people have been throwing money at deals without the consequences. And now what happens is a lot of these general partners have been raising money for these deals. Prices have gone up. If we've got a great army of limited partners and they're able to look at these deals and say, no, I'm not investing in that deal. Well, guess what? Those deals don't happen. Those deals get pushed down. Prices get pushed down. And all of a sudden, there's more equilibrium. Equilibrium starts to come back into this opportunity. So,
great, yeah, great, Gino. We have just a few minutes, and we'll wrap up. And kind of anyone has any last minute questions, make sure you get them into the chat box here, and we'll finish it out. Any what closing thoughts you have, or?
Yes, my battery was just dying on my computer. That's why I paused for 2 seconds. I'm like, oh, great, it's not even plugged in. So, listen, the 3 pillars of real estate, we can jump into that, but there's my information. If anybody has any questions on looking at a passive investment, for me, it is really one of the best ways. If you're working 50, 60 hours a week and you can't get into it, or even if you want to get into it full time, but you haven't had the time yet, to do a couple of passive investments, you can learn while you earn. And I think most people don't discount that. But all of a sudden, you have some credibility. And you can talk to a real estate broker and go, yes, I'm an equity partner in 300 units. Even though you may only have $50,000 invested in each, it's such an amazing way to get a foot into real estate, and you start learning. And then hopefully you pick really great sponsors. They have monthly webinars. What we did on ours, we had monthly webinars on our syndications. Every month we would have an update on what was going on the monthly draws. We would show all the CapEx, requirements that we did that month, and then we ended up going to quarterly because there wasn't enough stuff going on monthly. But what a better way to learn than having, once again, you have skin in the game. You're going to pay more attention to that asset, and as that asset is working, you're earning, and then you're earning. So that's a great way for you to get into real estate. If you just want to start investing passively, learn the business. You'll start learning all of the different players, because multifamily is not a really huge industry. Once you're in it for a couple of years, you'll meet a lot of the players in the space. But once again, what I said before, just go online, Google multifamily syndicators, and start opting into all of their lists, and you'll start getting those opportunities. And like I said, right there's a QR code. If you want to click it, you want to become part of Jake and Gino, listen to our podcasts, read our articles, our blogs. It's all in that QR code.
Yeah, Gino, I would echo that. There's a lot of good information. I describe the multifamily universe kind of like almost like a spider web at times. There are a lot of people just connected all across the country, all through various types of communities. So there's definitely not a lack of information that is out there, and a lack of resources if you want to get involved. You don't have to get introduced to the first deal and figure that's it. I'll just take it and we'll move on and see what happens. There are many deals to look at. There are many people to look at. There's many resources like that you provide as well, and that others provide, to really get that information if you're looking to become a limited partner in some type of investment. Obviously a lot of multifamily is what we see, but do your due diligence, take the information you learned today, and build your community out. It doesn't have to be just you making the decision. And I think, like you said, as you get more and more involved, you will meet more and more people and hear a lot of different thoughts and get a lot of just great information and guidance as well.
I think, Scott, the last thing I would say is, as a passive investor, even as an active investor, don't get FOMO, fear of missing out. We've had that, Jake and myself, over the last couple of years. It's been very challenging. We were able to say, hey, the market's going to come back. The opportunities are going to come back. So if you've got money in an IRA, just make sure, use that 3-step framework. Make sure you pick the right sponsor. Make sure that your interests and your goals align with that sponsor, and make sure you're choosing the right deal, and then invest that money. It's okay to miss an opportunity. I always say no deal is better than a bad deal.
Great closing comment, Jared. Gino, I think that's very important. I think in probably all walks of life, not just investing as well. There will be other opportunities. They do keep coming along. So, again, Gino, thank you very much for coming on and spending some time with us today. Thank you everyone who listened live. And obviously, if you're listening to recording as well, Gino had his information up. This is my information again. If you'd like to reach out to me with any questions that you have. At this point, we'll conclude the webinar. Gino, thank you very much again for joining us.
Thanks, Scott. Love hanging out with you, brother. Take care, everyone.
Likewise. Yeah, thanks everyone again for listening, and please visit our YouTube page for other events that we have and other recordings. Thank you very much.